Here's what's happening in self-storage and why it matters. One of the biggest shifts happening right now in the self-storage transaction market is the return of seller financing. In many secondary and tertiary markets, the buyer pool has thinned dramatically. In some cases, sellers effectively are competing for only one or two serious buyers in an entire market. Because of that, we're seeing something that was almost non-existent just a few short years ago. Sellers stepping in to help finance their own deals. Seller carry or installment sales used to be relatively common in the self-storage industry, especially among longtime owners who built their facilities decades prior. But during the peak of the market, when capital was cheap and buyers were abundant, most sellers didn't even consider it. They didn't need to. Deals were competitive, lenders were aggressive, and transactions moved quickly. That environment has changed. Today, when a property comes to market, in many smaller markets, there may only be a handful of buyers capable of actually closing. And those buyers are facing tighter underwriting, higher borrowing costs, and more conservative lenders. Seller financing helps bridge this gap. From the seller's perspective, it can help keep a deal alive when traditional financing alone might not support the purchase price. It also allows sellers to spread their tax liability over time and continue earning income from the property throughout the note. From the buyer's perspective, it can make the numbers work in a way that simply wasn't possible with conventional debt alone. We're seeing this show up in real negotiations. Partial seller carry, interest-only structures, or flexible terms that help bring both sides of the parties reach an agreement. What's interesting is that this isn't necessarily a sign of weakness in the asset class. And in many cases, the facilities themselves are performing quite well. The shift is really about capital markets and the size of the buyer pool. As long as the buyer pool remains thin in many secondary markets, seller financing will likely continue to play a role in getting deals done. This is a self-storage syndicator focused on real deals, real operators, and long-term value.